Hello, welcome to my channel.
Value added method or product method. Value added, that is value added to the goods and services. How can we? That is national income accounting. It is done in three ways, as value added method, income method and the expenditure method. Okay. So value added method or product method. Here gross value added. Gross value added is otherwise called GDP, gross domestic product. Gross value added means GDP at market price. If simply GDP, NDP, NNP given, it is to be taken as market price. Okay, so gross value added is otherwise called GDP at market price, gross domestic product at market price. How can we calculate it? According to value added method. Value added method. According to value added method, we can calculate GDP at market price or gross value added at market price. We know that gross includes depreciation. Domestic does not include NFIA. Market price includes net indirect taxes. So GDP at market price or gross value added at market price. What is it? It is the value of total money value of all the final goods and services produced in a country in an accounting year. So what is the meaning of gross value added? We have already mentioned that different types of goods are produced in different units, in kilogram, in liter, in meter, centimeter. Regarding textiles, it is measured through meters of cloth. So different units are used to measure different types of goods and services. So it is taken as money value. So GDP at market price or gross value added at market price is equal to sales plus change in stock or change in inventory minus intermediate consumption. Sales is equal to price into quantity. How many goods are produced in the economy into prices of that commodity. So price into quantity is we will get the value of sales. So value of output is equal to sales plus change in stock. How do we calculate GDP at market price or gross value added at market price? It is sales plus change in stock minus intermediate consumption. So in order to calculate the value of sales, it is price into quantity. Then by calculating sales plus change in stock, we get value of output. Okay, so we can write GDP at market price or gross value added at market price as sales plus change in stock minus intermediate consumption or value of output minus intermediate consumption, because sales plus change in stock we get value of output. So instead of sales plus change in stock minus intermediate consumption, we can write it as value of output minus intermediate consumption. Okay. So GDP at market price or gross value added at market price is equal to value of output minus intermediate consumption, or sales plus change in stock we get value of output minus intermediate consumption. Now what is the value of sales? It is price into quantity. So we can write it in different way. How is it? GDP or gross value added at market price is equal to value of output minus intermediate consumption. Value of output is sales plus change in stock minus intermediate consumption. Or how is the value of sales calculated? Price into quantity, sales, plus change in stock, minus intermediate consumption. Hope that it is clear. GDP at market price or gross value added at market price is equal to value of output. That is a value, total value of the final goods and services produced in the country minus intermediate consumption. What is the meaning of intermediate consumption? It is the intermediate cost incurred on purchase of raw materials and other intermediate goods which is used to produce the final good. Okay. For example, leather used to make shoe. Shoe is the final product. Leather is the intermediate product. So a cost is incurred on leather in order to make shoe. But finally we take the value of the final good, shoe only. Otherwise it will be double counting. Okay. If we again add the value of leather, it will be double counting. It will give us an exaggerated value of the output. So, value of output minus intermediate consumption. This is the value of the final product minus intermediate cost. The cost incurred on intermediate consumption. So, value of output, how can we calculate it? Sales plus change in stock. Sales plus change in stock. We will get value of output. So, value of output minus intermediate consumption, we get GDP at market price or gross value added at market price, or instead of value of output, sales plus change in stock minus intermediate consumption, we get GDP at market price. If sales is not given directly, if price and quantity given, price into quantity you will get sales plus change in stock minus intermediate consumption. So what about change in stock? Otherwise known as change in inventory. Every firm has closing stock and opening stock. In the beginning of an accounting year, there is a stock. For example, 100 units of the good is available with a firm as opening stock. And the firm wants to increase its stock to 200 units. And if the sales are going as expected, it can increase the stock or decrease the stock according to the sales. So 100 units is the opening stock. And the firm produces 1100 units of the good. For example, closing stock, the opening stock in a year. Opening stock in 2020 is equal to 100 units. With a firm, there is a stock of the goods. Stock of what sort of goods? Semi-finished goods or unsold good. It can be unsold good or semi-finished goods. This stock is 100 units. And the sales is 1000 units. So this is the sales. This is the production. Already there is opening stock of 100 units. So 1100 is the production. 100 is already there. So 1200. From that, how much is sold? 1000 units sold. So the firm has a closing stock of 200 units. Opening stock with the firm is 100. Firm produces 1100 units. So the total 1200, from that 1000 units is the sales. 200 is the closing stock. So change in stock is equal to closing stock minus opening stock. What is the closing stock? Closing stock is 200 units and opening stock is 100 units. So change in stock is 100 units. Sales plus change in stock minus intermediate consumption is the value of GDP at market price. So this is the basic of value added method. What is it? GDP at market price or gross value added at market price is equal to sales plus change in stock minus intermediate consumption. Sales is price into quantity. Change in stock is closing stock minus opening stock. Intermediate consumption is the intermediate cost. The cost incurred on the intermediate goods. For example, a firm purchases raw materials from the firms within the country. That is a domestic purchase. Sometimes the firm purchases from abroad. That is imports. Purchasing from within the country. That is domestic purchase. Purchasing from abroad. That is import. Okay. So I will write it here. These terms are very important by calculating, because in the question given, different terms will be given. So, first of all, if sales given, it is domestic sales plus export. So, please check in the question. If sales is given, it includes both domestic sales and export. Instead, if domestic sales is given, please check whether export is given. You have to add export to domestic sales. Then only you will get the value of sales. Sometimes only domestic sales will be given. No problem. You take it as sales. It can be understood that the firms have not purchased from abroad. So different ways the question will be asked. Sales include domestic sales, sales within the country, and export. So sales is equal to domestic sale plus export. Now, intermediate consumption. Intermediate consumption is the purchase of raw materials for producing a good. Intermediate consumption or intermediate cost is equal to domestic purchase plus imports. Purchase from within the country and abroad. So, if intermediate consumption is given, please understand it includes these two. But if domestic purchase is given, please check whether import is given. Then you have to add both. Okay. So, sales plus change in stock, closing stock minus opening stock, minus intermediate consumption. So, sales is domestic sales plus export. Intermediate consumption is domestic purchase plus imports.